Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. That's a double P. Missing that C. That's what happens when you're out of practice. This is the return of the Daily Energy Markets podcast for 2025 after our very, very substantial start of the year with the Global Energy Outlook Forum on earlier in January, where it's 70 analysts over 12 hours giving their predictions for the year ahead. Which we've been publishing over recent weeks, and the special report, which puts all of that together, will be published later today. So this is a curtain raiser to the special report, and no better person for curtain raisers than this group of commentators. We kick off the year with oil prices somewhat sort of knocking on the door of 80 with the sort of start of the year and through January. We've fallen back a little bit now. We're seeing Brent this morning at 77.82, the sort of rise in early mid-January through $80, and then sort of stepped back a bit as it seemed all the expectation that the Trump tariff scenario would sort of do things, and that there would be an elevation, a geopolitical risk, and sanctions would take oil off the market, and sort of some sense that oil might rise. But we've backed away a bit. So let's kick off this morning with Omar Najia, head of trading derivatives at BB Energy. Omar, your thoughts, 1 week of Trump 2.0. Do you expect him to be bullish or bearish for oil prices this year?
Trump is bearish for oil prices, structurally bearish for. So, in his first full year term, he kept saying lower prices, and then he talks about the GCC and tells them, I want lower oil prices, and I want you to invest in the US and all this kind of stuff. So he's going to keep saying the same thing, which is basically oil prices need to come down. I need OPEC to put more oil on the market and all that kind of stuff. So he is structurally bearish for oil prices.
Let's welcome Russell Robertson, Chief Commercial Officer at the Gulf Mercantile Exchange, but does spend a lot of his time in Singapore. Russell, your thoughts just at the start of the year, because inevitably we got the one side, Trump and America, and in some senses the influence that they have on oil markets. But of course, Asia demand, the center of incremental demand growth for the last 30 years. This feels like the first year in many decades, perhaps, that one cannot rely on Asia being the incremental demand growth of oil for the year ahead. Your thoughts of the role of Asia this year?
I think a lot of people are underplaying it, to be honest. I think I don't see anything massively changing this year. I think if you look at some of the prices we're seeing at the moment, some of the spreads have widened up. I mean, Oman now to Brent is $3.50 wide. That was 60 cents just 2 weeks ago. So that there is a lot more demand for Middle East crude coming into Asia. I think you probably covered it very extensively on your recent program, but the fact that Shandong and places like this are following up with the sanctions on the dark fleets, it's just significant amounts of restrictions in place, which is increasing prices, but actually the demand is still there. So we do expect to see a little bit more demand moving to probably India, but I don't foresee it being a huge change in China's demand this year, although a lot of people like to say that it's going to collapse, but it doesn't feel that way to us at the moment. And we generally see physical demand coming through our exchange quite solid this year. It's dropped a little bit on last year, but not really significantly. And we're starting to see that trend out. We're in our third delivery month of the year now. So although it's January, we're actually doing March loading, and volumes are quite steady.
Let's welcome Omar El Obeidly, Director of Research at Bahrain Center for Strategic International and Energy Studies. Omar, the big question this year, I mean, amongst the list perhaps in the Trump 2.0 universe, is the clampdown, a much more severe clampdown of sanctions. But we already saw that happening in the last few weeks of Biden, where he really got quite targeted with some of the, particularly the dark fleet, and now we have the outlook for the Iran's possibly facing a similar kind of rigid enforcement of the sanctions that we saw in the first Trump administration. Putting both the end of Biden and the beginning of Trump together from a geopolitical point of view, how do you read the tea leaves on that, on the impact on the energy markets?
First of all, I think that when it comes to sanctions on Iran, I think they're much more performative and expressive than they are, tangibly influential on behavior, because Iran's had a lot of experience with the sanctions, and it's got, it's already set itself up. It's got all its exit strategies, and it's got in China and Russia, two very powerful countries willing to help it evade those sanctions, and BRICS is coming along. So a lot of people are fed up with US's sort of capricious use of sanctions. And actually, we saw that this morning with Colombia. As they're opening the paper, they threatened Colombia with a 15% tariff for not accepting the deported Colombians, and then that was resolved within 24 hours or so. But I think that sanctioning Iran, there'll be a lot of headline efforts, but I don't think it will be particularly successful, because Iran has set itself up to get around it pretty effectively. And it really boils down to attempting to appease its ally Israel and his political base in the US. In terms of what that implies for the region, I think reality is that it's not going to imply anything particularly significant for the region. The fundamental or a key cause of disruption in the region at the moment is that the US is not willing to deploy its military might and its diplomatic might in a significantly de-escalatory fashion, which just leaves the playing fields open for whoever wants to try to sort of grab a larger slice of the pie. And I think we'll see a lot of that in the coming months and years, because Trump has basically ruled out using military means. And so really all he's got is economic sanctions, which is already maxed out on anyway. So I think it's going to be we're in for a very bumpy ride, even bumpier than the one we had under Biden.
Omar, you mentioned there the bearish expectation from Trump's policies. Your thoughts on how you expect OPEC to react to that? I mean, it was quite overt the first week in office, the speech to Davos last week. Trump featured OPEC Plus quite squarely in that, or particularly OPEC within the OPEC Plus, to reduce oil prices, particularly with the intention, as he articulated in that speech, to target Russia, so that Russia would be forced to the negotiation table regarding the war in Ukraine. Your thoughts on how OPEC Plus are likely to react to this Trump squeeze on increasing supply, reducing prices?
Well, first of all, Russia is not going to do anything because oil prices decrease or increase, right? So it's a strategic imperative for them. So they really don't care if oil prices go up or down. The war in Ukraine, they're going to win it. They're going to demilitarize, whatever it is that they're going to do, and that's it. So any sanctions is not going to affect that in the slightest. Same with Iran. They're going to do what they're going to do, and sanctions have been applied for 40 years. It's not going to change what they're going to do, right? So that when you get to OPEC and stuff like that, that's a little bit different, because I remember back when the US encouraged Saudi to pump max and try and destroy basically Russia's oil industry. And we saw what happened, right? Oil prices fell significantly, and Russia just kept smiling, and eventually Saudi Arabia had to start cutting production, and they lost a great deal of money. They're under severe pressure. So yeah, it's very difficult to tell. I mean, if they're rational, then they don't increase production, because basically they have budgets to meet. They have whatever it is, the Vision 2030, which is 5 years away. They need the cash. They need the revenue. Whether they're rational or whether they succumb to pressure is a very nuanced question. I don't know if I know the answer to that, to be honest with you. But I do expect that
Well,
people
it's
are.
hard to see. Never mind the OPEC plus. The other part of that sort of equation, he wants sort of OPEC plus to increase supply, but he also wants Houston and Exxon and all the big oil companies to increase supply and make it much easier for them to tackle regulation. And are they likely to reply? I mean, on both sides, more
No,
oil. Are the American producers likely to reply?
no, definitely not. If you look at the Permian, they asked them basically, the large producers in the Permian, are you going to increase, decrease whatever capital expenditure? About 35% of them said increase significantly. And the rest, the other 65%, said either decrease significantly, decrease slightly, or do very little. So there's no hope. I mean, nobody is going to invest in something when you keep telling them that it's finished, it's over, it's this, it's this, it's this, right? And Trump can do a lot of stuff basically for 3 years, 4 years, whatever it is. But these investments take a long time to pay out. So unless you're going to come in and say, forget green, forget this, and you're going to give people the kind of clear vision for like 30 years ahead, which I don't see happening, then they come in and invest. But unless you do that, they're not going to invest. So no, I don't think basically we're going to see oil production as in new discoveries and all this kind of stuff happen. In essence, the further you look down the line with oil and oil prices, the higher I see them going. The only question is, from where do we start? Do we start from right about here, $70 WTI, $80 Brent, or do we need to go $10 lower or $20 lower? That's the question. But the trend is going to be to the upside because of a lot of stuff to do with the US dollar, to do with inflation, to do with the general chaos that we're expecting. So higher.
Russell, I wanted to get your thoughts on a development last week, which is kind of obviously in your wheelhouse, but not in your specific house, and that is the story last week. Saudi Aramco bought its first cargo of U.S. crude that in the Platts window, WTI, and of course the Gulf Mercantile Exchange now in partnership with the Tadawul in Saudi Arabia and Aramco uses your exchange to price half of its crude, if I have that technically correct or not. But if you just address this story, why is it significant? Why is it significant? Why is it making headlines? Saudi Aramco buying a cargo of WTI.
Yeah, it is interesting. So you are technically correct that Saudi Aramco uses the GME price in a 50% formula with Platts Dubai, and that's for all of its exports to the east of Suez. It's a technical expression. Historically, Aramco has avoided directly trading in products that it uses for pricing benchmarks for obvious reasons. So the fact that they have bought a WTI contract in the window, a physical cargo, is significant from that basis. Aramco are doing more in the market. We do hear that. We don't see them directly, but we do know that they are active in many different areas in the crude space. So to me, it's not a great big surprise.
So is this just a reflection more of Aramco trading,
Yes.
the wholly owned subsidiary of Aramco, just becoming more mature traders, that it tells us anything about Aramco corporate?
Yeah, it's very much to do with Aramco Trading, not Aramco Corporate. So Aramco Trading is an independent trading firm, just like many NOC firms have these types of trading entities now or are building them at this time. So we expect all of those firms to start modernizing and spreading their activity and their portfolio into wider products. So it's definitely a trend that we see from other UAE NOCs are doing the same thing. There are 3 or 4 offices opened up in Dubai now for different NOCs trading. So yeah, I expect
KPC to join them this year.
Sorry?
I said KPC are set to join them this year, Kuwait
That's
Petroleum
right,
Corporation.
That's right, yeah. Batco also, KPC, obviously Adjunct Trading have done excellently over the last few years. And Aramco obviously is a mother of them all. So yeah, and OQT, I mean, is the classic one, Oman Trading, although slightly more independent than others. But yeah, it's a similar principle.
And is the collection of, I mean, now with KPC joining that family of NOCs of the region, getting more and more active into the oil markets, how is that likely to impact this year, or as the years go with these very big actors? Does it squeeze the independent traders out of the market? I mean, how do they all coexist?
They will coexist. I don't see squeeze. More futures, more derivatives will trade. It will create more opportunity, more arbitrage. If you look at Middle East derivatives last year, particularly, and when I talk about that, it's the Murban's, Dubai's, and the Oman contracts. They're up very significantly as a portfolio. They're up something like 25%. But if you look at some of the other ones, they're way bigger. If you look at the classic benchmarks like Brent and TI, their growth was something like 8% last year. So obviously in much bigger numbers, but the trend is clearly that these portfolios are moving more into more independent, bespoke, particular pricing points. And with companies like KPC and Aramco, etc., they are going to be looking at these things, not necessarily whereas the old traditional trading firms focused on the benchmarks. So I expect to see portfolios widen.
Omar, I just wanted to get your thoughts on where we start the year geopolitically and its influence in the oil markets. I mean, we had a statement over the weekend that in any other era would have shook the world. The US president sanctioning ethnic cleansing in the Gaza Strip, telling Egypt and Jordan to take Palestinians. Your thoughts on that alone, having no impact on the oil markets this morning, and then the other, Trump telling Putin to end what he calls the ridiculous war in Ukraine. But starting with the immediate news over the weekend, ethnic cleansing in Gaza.
I think that's very much, its non-effect on oil market is very much a result of the change in the global supply of oil. And you have US shale oil, you have all the new oil coming out of South America, and then you have, Russia. So I think that, the world, when you compare to previous eras, the world is a lot less reliant on Middle Eastern oil than it was. And so basically any disruption that may or may not be caused by having a continued violent conflict in Palestine and Israel is no longer as consequential to oil markets. And I think also when it came to Trump's position, he made his picks pretty clear from, I believe it's, a few months ago, and his cabinet is pretty much hardline, pro-Israel, and everyone's known that for almost, 2.5 months. So really his statement doesn't actually add any information to the markets. Everybody was expecting
the market doesn't believe it, or it believes it but doesn't think it'll impact energy flows?
I think so. First of all, I think that when he was elected, he immediately had a decline in oil prices because of the factors you discussed earlier. In terms of, do they think that there may be an increase due to increased conflict surrounding his recommended solution for Israel Palestine? Well, I think that one thing that we have to give him credit for is that, unlike the Biden administration, he did seemingly engineer the current peace treaty that we're seeing between Gaza and Israel. Because my understanding, officially happened under Biden. My understanding is it was under significant pressure from Trump's team. So I think in terms of in the short run, he's perceived to be someone who is contributing to less violence. But in the long run, I think that everybody's more or less given up, or nobody's particularly sanguine on either Biden or Trump's ability to find a lasting solution. And the specific content, like the recommendation or the request that Palestinians be moved to Jordan or Egypt, no longer actually has much of an effect on people's general perception. And in addition to that, because of the supply multiplicity that didn't used to exist in the 70s and 80s, even if he were to have a tangible effect on the conflict or a surprise effect, that in of itself would no longer have such an impact on oil markets. As Omar said, Iran, in the case of Iran, we've had sanctions for 40 years now. The regions had been dealing with conflict for so long, it's become the norm.
It's becoming immune, and inevitably still with 5 million barrels, or 6 as it's officially recognized, of idle capacity, then it would take a lot of disruption for the market to be short, I suppose. Let's go to the survey question, which kind of tackles this overarching question. After 1 week of Trump 2.0, will his policies be bullish or bearish for oil prices in 2025? We've seen a little bit. Obviously, it's only 1 week. We saw overnight some of what Trump punching back Trump looks like with Colombia was mentioned earlier. The Colombians refused to take their returned immigrants in American fighter jets, or however they were being transported, but then 25% tariff warnings were going in both directions, and apparently they resolved that in 24 hours. But nonetheless, it tells you what the dynamics of things still to play out. But after 1 week of Trump 2.0, will his policies over the course of the year, hour by hour, we can't really sort of call it, but obviously over the course of the year, will you expect his policies to be bullish or bearish for oil prices? Omar, I wanted to get your thoughts on the wider sort of financial markets relevance. Where the energy markets fit in that? The financial markets continue to go from strength to strength. I mean, if record is the word equal to strength, but ultimately equity markets hitting records every day. It seems Bitcoin moving firmly through $100,000. Your thoughts on where the financial markets are going with this first month of the year, what they might tell us or not? Will energy participate in that?
They're going considerably higher, as we've been saying consistently since we were like, I can't remember, 4.5 or 5,000. They're going to 7,000, then 8,000. They're going to go up. And the reason they're going to go up is not because of productivity or a miracle of AI, or which is very funny with the Chinese thing. But it's not because of any of that. It's because of one thing. It's called inflation, right? So the S&P tracks inflation. That's all it does. So inflation is going higher. How do we know? Because they want to, stop income tax. They want to basically not just give tax cuts, but they want to nullify taxes altogether. So anything that you look at is going to be inflationary. The debt, the amount they spend on servicing the debt, the military, all the aid that they're doing, all the building of bases and all this kind of stuff. It's just going to keep going up, and they're going to keep printing money. And by printing,
and what about
money,
rates in that fact then, in terms of, I mean, typically
rates. I mean, there's two things. There's the US, there's the Treasury, right? And then there's the Fed, right? So the Treasury needs money. The Treasury needs to sell that to get money. They need money because they're spending way too much. They need people basically to give them they need people to sell their debt to. That's the Treasury. The Fed is facilitating that because the Treasury is telling them, we're paying too much for this debt. We're paying these people too much for their money. We can't afford to pay 5%. We have to pay 4, 3, 2, 1. And the Fed is like, yeah, but that'll increase inflation. And Treasury is saying, we don't care. We need the money. Give us the money. We need the money, decrease rates. And the Fed will pretend that, inflation is coming down and we're really great and the trend is this and the trend is that. But you ask any kind of real normal person living in the US where they spend their money on groceries, cars, houses, education, blah, blah, blah. All those are going like this. They've got nothing to do with this fictitious CPI. So the Treasury needs lower interest rates because they cannot afford to pay $1 trillion plus a year on servicing that debt, with that debt constantly, that deficit increasing. Last year was $2 trillion in a year, and it's forecast to be a lot higher this year. So inflation will go up. The Fed, counterintuitively, is going to cut, which is why you're seeing.
But energy markets won't enjoy that either. They ultimately.
I think they will, but I think they have to basically find the bottom here and start to fade Trump out. I think they will.
Russell, I wanted to just sort of challenge your thesis a little bit on the China outlook. We started a year ago, the year last year, with a great lot sense of optimism about the robust strength of China's economic growth, recovery from COVID, and demand on oil would be robust. And as it turned out, it was sort of somewhat of a disappointing year, and oil prices from January proceeded to decline through the year. Your thoughts now, you're saying China will be better than this. We're starting a new year with the consensus is more or less the opposite of a year ago. China outlook is somewhat, expected to disappoint. It's going to continue to be stuck in a rut. We saw that sort of reaffirmed today with the Chinese manufacturing PMIs coming out below 50, 49.1 in January, which indicates a contracting production of manufacturing in China. You thought, where does China growth come from if it's not coming from its traditional centers like manufacturing and so forth?
I sort of have to highlight a bit what Omar says, really, because you find when you look at a lot of these economic data now that you find that it's not quite as easy to interpret it as it probably was done 5, 6, 7, 8 years ago. Yes, below 50 has always been a number that you'd worry about, but then we have to look at the Chinese government and the investments they're making and the funding, and they're pushing into the economy to try and kickstart things. So you can't ignore that. When you speak to clients, there's clearly is some sort of positivity. I don't sense, speaking to Chinese customers, that they're particularly worried. I think the feedback generally is they're looking for a flat year, but then you have to say, what's a flat year? A flat year is actually growth. Historically, last year
5% is flat in the context of China.
Yeah.
Do you expect? Is there an expectation that China's stimulus campaign will continue, will get bigger, will get stronger, or how do you see that?
They're not going to stop now. It started and it's going to continue.
Yeah, it feels like they're committed, but not necessarily with any sort of bionic punch. I suppose they're waiting to see how big the Trump punch will be in context of sanctions or tariffs on China.
I mean, just to Omar's point, the inflationary risk that we're seeing in the West is going to be significant, and I'm a big believer in that too. With that, you'll probably see some sort of commodities super cycle, and maybe that's a bit of an over sensational comment, but that puts the West into a slightly difficult position and only helps the East to benefit from that, if you like. So we might start to see some transitioning of where that growth comes from. So yeah, last year people did say China was looking bad, but actually it still grew, which probably outgrew other places. So it was interesting to see how people viewed that growth quite negatively. Yeah, it was quite positive on paper.
Omar, last word to you, and sort of put you on the spot a little bit, sort of your year outlook for the geopolitical stability in the region. As you mentioned earlier, Trump seemed to be part of choreographing the ceasefire in Gaza. Both Gaza and Lebanon are in ceasefires that have to move towards some sort of permanent agreement. So they're fragile ceasefires that could unravel at any moment. We saw some sensitive moments over the weekend. Lebanon was meant to have Israel withdraw by yesterday. The opposite happened. The Israelis killed, I think, 20 Lebanese in another strike. So I wanted to get your sense of where these ceasefires go. Can we get to a more stable year in the region?
So I think that the key factor here is Trump. Trump has been cultivating a reputation as someone who, fosters peace in the region. And if the Israelis are party to an escalation in conflict, this will not make him happy, and he has the tools and has seemingly deployed the tools to coerce Israel. And he also, maintains a good relationship with them by, rewarding them on other dimensions, so to speak. So I think that whereas under Biden, Israel basically had a completely free hand to do whatever it wanted. Under Trump, although he favors them in many dimensions, when it comes to escalating violent conflict, I think he has a pretty firm position on him not wanting it, especially in the first year as he's trying to, as I say, present himself as potentially the broker for the deal of the century and so on and so forth. I'm not confident that this will last all the way through his administration, but I do think that, the Israelis will also see the sense of de-escalating in terms of, first of all, trying to get their economy back on the right track, trying to get their conscripts back in the office. They've suffered a significant material, human, and financial cost from the protracted nature of this conflict. And so probably there'll be significant support for not escalating. However, you know as well as I do, Sean, that this is the Middle East. Anything can kick off at any second, unfortunately. And I guess in particular, we'll be waiting to see what the Houthis do with the Bab el-Mandeb, because they're supposed to have stopped. They were tying their the suspension of their disruptions to the existence of a ceasefire. If that continues, how that evolves, that's a big joker, a wild card when it comes to describing the potential path of conflict in the region.
Well, let's hope these ceasefires turn into permanent ones, and all of the relevant people under those conflicts have some peace and stability and some way to have a more optimistic outlook for the year ahead. After 1 week of Trump, this room thinks it's more bullish than bearish. We'll post that on social and get a wider view on that. But oil prices trading, Brent in Asia this morning below $78 a barrel, down in early morning trade. Let's see where the week goes. Omar Al-Baidli, thank you to be back at this table. Russell Robertson and Omar Najia, three of the best in the business. Thank you very much. Look forward to your voices through the year. Have a great week. All the best. Thank you.
Thank you.
Thank you. Thank you.